Welcome to my YouTube channel. I'm Eric, and today we're going to follow up the silver review with a gold review. So let's pull down the matrix. You can do the same, or you can follow along on mine. And we're going to take a look at gold and see how it interplays with silver. And it's located here on line 28. We established the phase, which is quite easy because we just look at the code. It's R plus 6. R plus 6 is a reset 6 days old past the reset point. The question is the daily or the monthly primary trend too extended to escalate? These numbers that are very low, hovering around 0 and still negative, suggest that the price and time cycles are still relatively young, so the reset is not a problem. The question is did we buy it 6 days ago? The answer to that lies in energy, and just like silver, which has a very big negative or bearish energy build, gold has one too. So it was a reset that I would have not chased. I didn't write about it, or I didn't comment. I always define this as they're not viable resets. This one should be ignored. We're in the frustration phase of probably what I would consider to be an upward grind of both gold and silver. It's something where you probably are going to make money on it, but it's going to be filled with volatility. And why is it going to be like that? Because of the energy. The build in gold and silver are similar. This is the composite precious metals DI, which is also located in the matrix. You can find the link. It's down below. You can access this chart in the cloud. It also has a relatively large bearish energy build, negative. It's going to have to be released up to here. The setup is similar to silver and similar to gold. It creates this this composite DI. It has I've written about it in silver. We are most likely paralleling a 2009 setup where several large blocking domes are going to cause frustration and slow the advance like this until this gets released into a bull. And it's not going to be a massive one. It's going to be a upward move from here to here, and it's going to create these thin lines of which they're going to represent buy points, which the markup will accelerate. That's what we're looking for. That's why you subscribe to the matrix. That's why I follow this, because it's a patience game until then. But we're going to hold our core position because the primary trend is fine. If it flips, you change your mind, but it's not. And we're going to wait this one out. We'll talk about it when the time comes, but you probably won't need my help. This is energy, so we'll stop here. Let's look at some of the intermarket plays that also play into the bull market for gold and silver, which are also in the matrix. There's the confidence oscillator, which is an important part. I can't remember in the matrix, it's down on line 103, but people misunderstand why gold is running and what's going on. I know they think it's a monetary play against inflation. I severely would check that idea. Gold is a confidence hedge. It's always been that way. It's a confidence hedge against government and all the crazy stuff that it's doing. I've written about it in detail. I try not to interject my opinion, but this is a discipline based on mathematics and trying to remove your emotions. But I think our government and the phase of government that we're going to have is going to definitely be tested, possibly transitioned. We can talk more about that, but outside of a specific review. But what we're looking at here are this confidence oscillator, and it goes back a fair amount of time. The computer establishes cycles. The red boxes, which are loosely associated with one another, create negative cycles or bearish cycles, and then the boxes in between them that are not highlighted, those are bullish confidence cycles. And what the computer told us, and I wrote about it at the time, is the last bullish phase of the unhighlighted box was the longest on record, and that hasn't changed. We have flipped now to a bear phase, and I know that people are expecting a return to normal and confidence is just going to quickly get back to what we're used to, but that's unlikely. We might have an interrupted box because obviously these boxes aren't all red. It's not one solid block. It could be interrupted, but the chances are is we're going to have a long red box, which is a long bear phase, and it's going to kick us in the can, so to speak. I think people are not prepared for a long bull phase or bear phase. The bear phase is marked by these green arrows. Technically, I could move them up and say, hey, it's going to go up here, but I don't really want to do that. We're going to have something of that. A large bull phase is going to be tends to be followed by a large bear phase. And what does that do to gold? Well, this is gold right here. So obviously, gold goes into a well-defined markup phase during these red boxes. Now, this is the S&P 500 down here, and performance is relatively mixed. You can say it's actually somewhat bearish during the which this is where the problem comes. Is the stock market going to be a confidence hedge, or is it going to hold a traditional role? If it is a confidence hedge, it won't last forever. Gold's rally will last a lot longer than the stock market's rally. Give it 2 years at the most. The stock market should be correcting as we head into a recession, but it's kind of doing some different things based on capital flows, international capital flows, and intermarket cap. I can see them. But it's not even a guarantee that we're still locked in on it. This is another discussion. I don't want to go too far into it because we're still talking about gold. But we must be careful about this. The market is rising up and everyone's bullish. And that's it's a dangerous assumption. Gold is a much safer play because this is what the computer is telling us. The stock market's still kind of 50-50, and even if it is, it's going to give us 2 years. So let's take a look at one more aspect of intermarket flows for the gold market, and then we're going to call it this review done. Let's open up the precious metals complex, which is back in here, and I'm going to pop through it. You don't see this, and you can see this chart inside the matrix. This is the precious metals complex trend oscillator, or the PMC. Essentially, the green boxes mark when it's above zero, and they're bullish intermarket flows. They're driven by foreign capital as well as domestic. They're not huge, large boxes because this is on a weekly basis, but they do tend to organize. Unfortunately, it doesn't go back too far because continuous data series is not that easy to get. I would have to backfill it, which I could at some point, but I haven't done that yet. But these green boxes here establish bull phases, and that's when the price of gold tends to really accelerate. Notice how it accelerated after 2009, and we picked up speed. As long as this green box is associated with a bear phase of confidence, we have a perfect storm set up for the price of gold and silver. There's other things to look at, but I don't want this review to go too long. The gold and silver ratio, but we're going to hold that off for another time. So the play in gold basically right now is the same as silver. It's hold the core position and patience. We are not escalating it. It's not chasing the reset. Perhaps you want to, but that's not what I would do. I would wait for the energy builds to dissipate onto the bullish side, and I will write about it or talk about it. If you have any comments on anything that's going on in precious metals or anything that we're talking about on the blog or Twitter, contact me. There's a comment. Subscribe to the channel below or in YouTube, and enter comments below. I can respond there just as well. I'm sure it's going to pull in a lot of people that don't read the blogs and are not subscribers, but that's the whole point, is to start educating about the evolution of the trade. That's a really important concept, so please go over it. Again, have a good day, and we'll have another review again soon. Thanks.